morning, dear learners. A very warm welcome to you all for a topic on insurance and risk management. So, myself, Dr. D. Sarita, Assistant Professor of Commerce and Management, Government Degree College for Women, Begumpet. So, today we are going to discuss about risk management insurance for BCom third year student semester 6th. So, what we are going to learn today? So, what is risk? What are the sources of risk? How this risk can be managed? What are the different types of risk? How to handle risk in our daily life? Role of insurance in risk management? How does insurance reduces risk? Then we will conclude the class. So, what is risk? As we all are very well aware, risk is involved in our everyday life. So, our future is uncertain. Even a son goes to college, a mother is worried about his son, whether he reached college or whether any accident takes place. So, in business, when a businessman starts a business, he will be having a positive thought that he will earn good profits in future. But we have witnessed that corona pandemic has totally closed everything. So risk is uncertain, it is unexpected. So when we expect the things to happen in a positive way, but the things are not happening what we are expecting or vice versa, then there involves a risk, there involves a hazard. So when such unexpected events occur, there is invariably a sense of loss, which may or may not be measurable in terms of money. So when your jewelry unexpectedly stolen by theft, there is a monetary loss. But if someone loved one from our family member unexpectedly dies, you feel a great loss, but this loss is not measurable. So for measurable risk, the insurance companies will cover. So any financial loss which occurred, non-monetary loss, that insurance company will not cover. So monetary loss happens, that will be covered by our insurance companies. So what are the different sources of risk? So risk, as we have seen, it all about losses. So in the absence of possibility of loss, there would be no risk, but it is important to know the factors which cause or contribute towarding occurrence of loss or extent of loss. So these are two such factors, and these factors are perils and hazards. Perils means loss. So in insurance language we can say peril is a loss, or peril is an insurance term for an event that could cause damage to property, items or belonging insured. Example, when flood occurs, or any flood, due to the flood the assets are damaged, then so many people will die, or some people may fall sickness, and theft, terrorism, these etc. are perils. So what are the types of perils? So when we understand the risk, we need to understand the perils also. So first one, there are three types of perils. One is natural peril, second one is man-made peril, and the third category of peril is economic peril. So any act of God or any natural calamities will happen, that is called natural perils. So these perils are unexpected, and these may cause a huge loss for the humans as well as the assets as well as the countries. So several natural calamities like floods, heavy rains may cause a loss to the farmers, the people who are living, so they may lose their lives also. So these kind of perils are called natural perils. Then the second one is man-made perils. So man-made perils occurs due to the theft of our jewelry, theft of our assets, or theft of our any items, riots, due to the strikes, and due to the malicious damage, accidents etc. are man-made perils. So in man-made perils, we can give an example. To claim the insurance, the owner of a shop maliciously he will burn the stock and then he will claim the insurance. So these kind of perils are man-made perils. Then economic perils. So the third category of peril or cause of risk is economic in nature, and the best example for this type of risk are depression of industries. So due to pandemic, the most of the industries have shut down their daily activities, and due to that there is a depreciation in the market. And then inflation means the normal commodities are high prices, then local fluctuations and the inability of the industrial firms. So these causes natural perils. So the second type of loss which cause is hazards. So while perils are the direct cause of loss, hazards are the underlying factors for that loss, which increases the probability of occurrence of loss. So hazards usually they increases the probability of the occurrence of loss, and there are so many conditions which are more hazardous than others. Example, if we see the worker who is working at a Singareni, he is more hazardous, that is a more hazardous occupation than that of a manager who is working in a bank, a teacher who is working in a college. So because the person who is working in a Singareni college, he has to prone to more accident, so his life is in dangerous. So hazards are the dangerous which have the more probability of occurrence of loss. So owning a property on the banks of Ganga is more dangerous than a property in Hyderabad, because Hyderabad is a safe place where at the Ganga exposes due to floods, and there may be a dangerous to the property. So it is exposed to the risk of damage due to floods. So the houses which are nearby Ganga river are more exposed to the risk of danger of due to floods. So hazards. So by this example we understand that the hazard means the increase the probability of occurrence of loss. Then there are different types of hazards, physical hazards, moral and moral hazards. So physical hazards are related to the physical aspects of the property, means here the physical property will be damaged, which may influence the chance that this property may be damaged. So the example just now I have given about the house which has constructed near the Ganga river, okay. And the moral hazard also affects the probability of loss occurring, and the risk is increased. So a dishonest person may set fire in his own house or property on fire to avail the insurance benefit. So we have seen in so many movies these kinds of examples we will see. Moral hazards also affect the probability of loss occurring, and the risk is increased. So a dishonest person may set his own house or property on fire to avail the insurance benefit from the insurance company. So in many movies we will see these kind of examples where the owner itself appoints some thief to steal all his jewelry from the shop, and he claims the money from the insurance company. So these kind of hazards are moral, which are lost to the insurance company. So the third one is moral. So moral hazard is an attitude or lack of concern about the outcome of his action. So here I have given one example. A smoker who is who smokes and he stubbing out cigarette and just throw them around, not at all even he least bothered if the cigarette the cigarette he thrown may occurs or cause some fire, or if some huts are near there, then they may catch fire easily. So these kind of hazards are moral hazards. So which are the and lack of concern about the outcome of his action, individual actions or group actions. So this is moral. Then how we can overcome risk? So what is actually risk management? So a well organized risk management system is very important for ensuring the optimal success of businesses in long term operations. So the main aim of the management is to find the possible risk. They have to identify the risk, they have to assess the risk, and they have to prioritize the risk. So according to the risk, they have to manage the risk. So the risk management is an important part of an organization to expect the what is going to happen in the future. So to expect the losses, to expect the uncertainties in the future. The main aim of risk management is to find the possible risk before they create havoc. So in this system and strategy, and they need to do some plan for some strategies to handle them in a advance for negating the impact on their business objectives. So a proper risk management guarantees several key aspects of business like smooth flow of operations, enhanced productivity and revenue generation, but many businesses owners are not clear about the role of insurance in the management process. So there are so many risk management techniques, but the insurance is the one of the best techniques to be followed by individuals and businesses to manage their risk. So simply what is risk management? Now we have understood how the risk management helps, but now we need to understand what is risk management. So risk management is the process of handling risk. So as we understood, future is uncertain, their future business may also go into losses. Suddenly the business may wind up due to the market risk, due to the operational risk, but the business has to know the process of how to handle the risk. So risk management helps the businesses in the process of handling the risk. So risk management refers to identifying and controlling the risk surrounding with our decisions and actions, whether they are risk associated with your assets, whether the risk is associated with your health, whether the risk is associated with your life. So when we assess these kind of risks, then the risk management helps in identifying the kind of risk. So a highly preferred tool to minimize risk is insurance. So the primary purpose of insurance is to reduce the risk and faced by an insured person. So risk management is crucial to avoid losses in life, business and assets. So whatever the losses which happens in our life and the loss which happens in our business, by taking a suitable insurance we can avoid the losses of life, business and assets. So risk management and insurance planning. So how these two works together? So risk management and insurance planning play crucial roles in creating a comprehensive financial plan. So while we all hope not to face major tragedies, so no one will hope that I am going to die, or any my family member is going to die, or my business is going to loss, or my business is going to wind up. So the death of a spouse, an injury that prevents working, or a major health crisis. So these are the unexpected perils which are going to happen in our life. So planning for them help best protect the interest of the client, so their family and any business interest they may have. So the insurance planning, a proper insurance planning helps the individuals, business houses to protect their future uncertainties, to protect their life, to protect their health by facing any financial issues. So, how to handle risk? This is very important. As we know, the risk is uncertain. It is definitely going to happen in the future. May or may not happen, but still we should be ready to face anything which is going to happen in our future. So, there are some of the methods which are used to handle risk. One is risk avoidance. So, the simplest way to deal with risk is to avoid. Okay. So, if a factory is to be located on the banks of a river, so we know that which is very much prone to the floods every year, then the business owner has to decide that the factory should be shifted from the banks of the river to the safest location. So, and even for example, if our bike or our car is in repair, the brakes are in repair. So, while going out we should check, or if we know that the brakes are not working properly, we have to go to the mechanic and we have to repair our car. So, through this we can avoid the risk. So, by going out to overcome the risk of the theft, we have to lock our houses and then we have to go out. So, these are some examples how we have to avoid risk. So, by having healthy habits, by taking healthy food, by exercising every day, we can avoid the risk of our health. Okay. So, health, if any health problems will occur in future, we can avoid those risks. So, the how to handle risk is, first we have to avoid the risk. So, the first one is risk avoidance, and the second is loss prevention and reduction. So, we have to most possibly when a loss due to risk, that may be eliminated or minimized by loss prevention and reduction measures. So, some measures such as strict enforcement of no smoking regulations may eliminate fire losses. For example, if you see at the petrol bunks, there is definitely they will follow that no customer should talk on phones or no one should smoke there. So, by taking this kind of strict enforcements, so they can prevent the loss. Okay. So, at the petrol bunks, petrol stations, if any person will smoke, definitely there is a high chances of catching fire. So, we can do some loss prevention and reduction techniques. So, by strict enforcement, by taking some strict measures, we can avoid loss. Then the third is risk retention. So, what is risk retention? It may be consciously decided to retain some risk. For example, if I have two kids, one is girl child and one is boy child. So, for girl child and boy child, for their education, I have to from now onwards I have to plan for their education. When they go to graduate or their dream is to go to some foreign countries for education. So, from as a mother, as a parent, we have to plan before only. So, by that we can retain the risk. So, creating insurance fund to meet future emergencies is one of the example of handling risk. So, for life also, suddenly if you are the bread earner of the family, so we need to do some before planning to overcome that after our, if any uncertainty will take place with our life. So, our family, in our absence, our family members should not affect. So, the routine life, the education of the children, the marriage of our daughter, or any business which is already going on, that should run as normal. So, we have to plan. So, by handling the risk retention technique or by creating some insurance fund to meet future emergencies, it will help. So then next is transfer of risk. So risk transfer occurs when the activity that creates the risk is transferred to another. So the most important method of risk transfer is insurance. So what we will do, we will pay some premium money every month or every year quarterly to the insurance company, and we are transferring our risk to the insurance company. If something unpleasant thing happen in our organization, or some death occurs to the head of the family, so the risk is transferred to the insurance company. So the insurance company will give financial assistance to our family in our absence also. The next, there are some general guidelines for handling risk. So depending upon the types of risk, and the suitable methods were suggested. So when the risk have low frequency and low severity, so then we have to adopt for retention of risk. And then when the risk is high frequency and low severity, we have to control the risk. So we have to control the loss. And when the risk is high frequency and high severity, we need to avoid the risk completely. We need to avoid the risk. And when the risk is low frequency and high severity, then the risk should be transferred. So we should transfer our risk to insurance companies or any other. So these are the general guidelines, and according to the which type of risk, the suitable method we can apply. So then the next is, we are going to talk about risk insurance. So what is risk insurance? So risk insurance refers to the risk or chance of occurrence of something harmful or unexpected that might include loss or damage of the valuable assets of a person, or injury or death of the person, where the insurer assess these risks and based on which work out the premium that the policy holders needs to pay. So depending upon the risk, the premium we have to pay. So this risk may be, means the risk insurance may include loss or damage of the valuable assets of a person, or a serious injury causes to the person, or sometimes the death of the person, where the insurer has to take the insurance. So how the risk insurance will work? So unexpected, if you see this diagram, in the diagram we can understand that unexpected event will take place, and then that unexpected event will cause damage to the assets, or it may also leads to the death. So while taking insurance, the insurance company will provide protection against the loss or damage. So here the risk of the individual is transferred to insurance companies. So like this we can manage our risk. So there are different types of risk. One is pure risk, dynamic risk, speculative risk, static risk, financial risk, fundamental risk, and non-financial risk, and particular risk. So these are the different types of risk which we are going to understand now. So what is pure risk? So pure risk refers to the risks that are beyond human control. So these risks we cannot control, and the result in a loss or no loss. So these may result in loss or no loss with no possibility of financial gain. So some fires, floods, and other natural disasters are categorized as pure risk. So fire takes place, it is not on our control. The floods and natural calamities are the act of the God, which are not in human control. So sometimes due to heavy rains, villages, the farmers may get affected, but in our cities we may not get affected so much. So there may be a possibility of loss, or there will be a no loss. So when these kind of risk are involved, these risk is called as pure risk. Or when unforeseen incidents such as act of terrorism, also leads to some death of the person. So, these kind of risks are categorized under pure risk. So, there are three types of pure risk. One is personal risk, one is property risk, and the third one is liability risk. The second type of risk is speculative risk. So, speculative risk refers to the situation where the direction of the outcome is not specific. So, what is going to happen we don't. We may gain, or we may lose, or we may break even. So, for example, if we invest in invest our money in shares, so the shares may give us good return, they may not give us good return, or they may break even. So, there is no profit, there is no loss. So, these risks are generally not insurable. So, speculative risks are thus considered controllable risk. So, if you betting on sports, for example, a person betting on a IPL cricket matches could see either a financial gain or loss from the bet. So, depending on the whether the team that chosen wins or losses. So, if he chooses the best team, the team may win or may not win. So, speculative means just we will expect, the outcome will not specific. So, it will lead to a condition of maybe loss, maybe profit, or maybe break even. So, when these kind of risk is involved, the risk is called as speculative risk. And the third one is financial risk. So, financial risk refers to the danger in which the outcome of the event is measurable in terms of money. For example, any loss that could occur due to the risk can be measured by the concerned person in monetary value. For example of financial risk includes a loss of the goods in the company's warehouse due to the fire. So, how much goods were there in the company, that we can calculate the loss. So, these risks are insurable and generally the main subject of all insurance. So, the main subject of all insurance companies are financial risk. Okay. So, the financial risk may be credit risk, liquidity risk, and operational risk. So, when the risk or the outcome of an event which is measurable in terms of money are referred as financial risk. And then non-financial risk. The fourth type of risk is non-financial risk. Non-financial risk refers to the risk in which the outcome of the event is not measurable, okay, in terms of money. So, any loss that could occur due to the risk cannot be measured by the concerned person in the monetary value. For example, if you choose a poor selection of a car brand, so that car is not performing well, so it is non-financial loss, okay. So, non-financial risk. So, an example for this is a poor selection of the brand while purchasing cars, while purchasing mobile phones. So, these risks are uninsurable since they cannot be measured. So, it is purely your decision. So, the your choice. So, the car which you have chosen is not performing up to your expectations level. So, this is not insurable by the company. So, these kind of risk comes under non-financial risk and they are usually not insurable. So, the particular risk or specific risk. The fifth risk is particular risk or specific risk. So, particular risk or specific risk are those risks that affect only individuals rather than the entire community. So, burglary, theft, auto accidents, when a house sets fires, because that loss is only limited to the individuals. If accident takes place, the individual is injured, it will not affect the group, it will not affect the any particular group of persons. So, These kind of risk are called particular risk or specific risk. So, these risks are uninsurable because when we met with an accident, if something happens, that we can claim insurance from the insurance company, and these kind of risk are the generally the main subject of insurance company. So, for this kind of risk only most of the people will buy insurance from the insurance company. So, these are the main subject. Financial risk and particular risk are the main subject of the insurance. Then the next risk is fundamental risk. So, what is fundamental risk? Fundamental risk refers to the risk which arises due to the cause which are not under the control of any person. So, the impact of this risk is essentially on the group. It affects the large population. The fundamental risk includes high inflation, unemployment, war, if suddenly some war takes place, the natural disasters such as earthquakes, tornadoes and floods. So, these will affect group of people, not single people. Sudden if flood comes or earthquake comes, it just not comes in our it just not occur in our single home, but when earthquakes occurs, it will affect the whole the place or the group of people will be get affected. Okay, then this is fundamental risk, and the next risk which we are going to understand is static risk. So, what is static risk? Static risk refers to the risk which remains constant over the period and is generally not affected by the business environment. So, these risks are from human mistakes or actions of nature. So, an example are embezzlement of funds in a company by its employees. So, they are generally easily insurable as they are easy to measure. So, we can understand that which are easy to measure in terms of monetary losses, those kind of risk are insurable. And dynamic risk refers to the risk which arises when there are any changes in the economy. So, these risks are generally not easy to predict. These changes might bring financial loss to the members of the economy. An example of the dynamic risk is the change in the income of the persons in an economy. Their tastes, their preferences, impact of other countries' culture. So, these are generally not easily insurable. So, now we have understood risk, what is risk management, how to handle the risk, and what are the different types of risk. So, insurance is one of the best tool to manage the risk. So, life, as we all understood that life is uncertain, and business also being exposed to many kinds of risk and uncertainties. So, it requires you to shield yourself from the potential risk, even though a person may not be able to avoid the risk, but he can surely mitigate them via accurate precautions, via accurate insurance planning. So, investing in insurance is not an investment, it is a risk management tool to protect future income which secures your family's future. So, the key is to manage the risk is not to avoid it, but to plan it in a better way, to minimize the risk and to handle the risk in a better planned way. Thank you.